So inflation holding steady at 1.7% for May. Some say officials should now focus on another issue in this country, unemployment. Let's bring into a conversation Vinayak Seshasayee, portfolio manager at PIMCO. Thanks for joining us today.
Thank you for having me.
Let's talk about core inflation first, if you don't mind, which is still being sticky. I'm wondering how big of a problem that will be for the Bank of Canada when it comes to the next rate announcement.
Yeah, I think, look, we would characterize today's core numbers as being in line, even though the near-term numbers, particularly the measures that the bank focuses on, have been towards the high end of the target. We think that there is strong reason to believe that in coming months, they are likely to see, a little bit of easing, particularly from sectors like shelter, which, if you remember, for the past 2 or 3 years has been running much higher than target and is finally easing towards the top end of the target band. So we see more easing in shelter. I think another reason why we feel pretty confident that core inflation is headed lower is because we think that a lot of the spike in the past several months was related to the weakening that we saw in the Canadian dollar towards the back half of last year. Now, we know that that's been reversed, and the Canadian dollar has gone from 68, 69 to closer to 73 cents to the dollar now. And we do think that that will show in some of the sectors like goods, especially given that the US is close to 70% of Canada's exports and imports in terms of trade. So I think that strengthening the Canadian dollar does also support the case for lower inflation. And then lastly, as you said, the other big problem, there's plenty of slack in the labor market. We do have an unemployment problem. And when we have that kind of slack in the labor market, people tend not to consume as much as they normally would. So we do think, we feel pretty good that inflation will continue to converge towards the target, and that will allow the Bank of Canada to continue their easing cycle as we get towards the fourth quarter.
Okay, so let me ask you the question that we put to many people is, second half of the year, are we still going to see some of the tariffs work through? And how do you see that playing out for inflation? Because you actually say you see the Bank of Canada lowering a rate and inflation should be, I guess, steady.
Yes. Yeah, so part of that is also related to a view that we have, and certainly our base case is that over the next several months, we will get to an agreement on the tariffs issue. And ultimately, we don't think that, at least on the Canadian side, the US side is a different story, but at least on the Canadian side, we don't actually think that there's going to be a material pass-through from tariffs into consumer prices. Now, the US
has that changed recently? Has your view on that changed recently, or did you have that view from April on?
I think that's been the view over the past couple of months. I think we've seen a lot of, I would say, positive commentary from both sides in terms of the politics. I think there's a strong desire to get a deal done. President Trump, as you know, has said that he would like to keep the previous USMCA agreement, which actually is up for renegotiation next year. So there's a lot of incentive from both sides to ensure that the trade agreement remains intact. And even though we might have one-off tariffs on specific sectors as we get towards the end, we do think that the case for a deal is much higher now than it was, let's say, 3 to 4 months ago.
Okay, let's talk about other geopolitical factors here. Of course, we have what's going on between Iran and Israel. So we have a ceasefire technically in place, but how much faith do you put in that ceasefire holding, and what do you expect sort of from oil prices moving forward?
Well, that's a tough one. I would say the honest answer from where we sit and our view is we don't know. Yeah. At least as it relates to the ceasefire and how this will evolve over the coming several months. We're certainly working with an assumption that oil prices will remain in a broad range. And by and large, we do think that there are several other factors weighing in on Canadian inflation aside from oil prices that will, likely offset the impact of a short-term spike in oil prices.
You mentioned unemployment, and you mentioned that Canadians perhaps are wary of the fact that more people are unemployed and maybe making them more careful. What is the fix for that?
Well, there's only one fix for that, and that fix is growth. I think the unemployment rate is actually a bigger problem than most people realize. Headline unemployment in Canada is at 7%. The last time we were here outside of COVID was in 2016 when we had the oil shock, if you remember. Oil went down to $30 a barrel. But more importantly, if you look at unemployment amongst people aged 30 years or less, it's actually 11.2%. You have to go back to days after the global financial crisis to get a number like that. So it's actually a bigger problem when you delve under the hood and realize that young people in this country are having a lot of trouble finding jobs. There's really only one fix for that, and that's growth. Growth can come from two ways. Either you get it by lowering interest rates. That will allow mortgage rates to come down, give people a little bit more money to spend. One thing we have been seeing is the last 3 or 4 cuts that the Bank of Canada has done, it actually hasn't passed through to mortgage rates in a meaningful manner. 5-year fixed rate mortgages are still within 25 basis points of where they were, call it 6-7 months ago. So we do think a little bit lower on the rate side will give a little bit more push to the economy in terms of growth. And then second, and something we're also banking on quite a bit, is a fiscal and trade resolution. So we've got a new government in place with a mandate for, radical change to some extent. And we do think over the next several months, we're going to start to see some of the uncertainty clear in terms of, how the trade relationship will evolve with the U.S. I think that's putting a lot of brakes on business spending as well as consumer spending. And then we're likely to see a little bit more fiscal stimulus as well, probably geared to a bunch of different sectors that is going to stimulate growth.
Okay, so let's talk about the U.S. for a moment, because the Bank of Canada has been doing its own thing. The Federal Reserve has been doing its own thing. Donald Trump's put a lot of pressure on the U.S. chair to cut rates. But he said even today, nope, we got to look at the information that comes out as a result of what the tariffs have done. Yes. He doesn't seem to be in a hurry, but most people are expecting cuts at the end of the year.
Yes.
Do you expect the same? How much longer can these two nations sort of diverge on this?
Well, on the matter of the Fed, we do think that the Fed will also eventually cut rates, probably by a 0.5 point or so, but more towards the end of the year. I think one thing we remain pretty convicted on is that the Fed continues to remain independent. They have an inflation target, so we don't necessarily see them as vulnerable to a lot of these calls to cut rates by 1 point or more. They're going to continue to do what they think is right for the economy. And right now, the reason they're on hold is because they just want to see how the price impact from tariffs shake out. So far, it's been a little underwhelming. So we actually haven't seen the extent of upside price surprises that we were expecting to see 3 or 4 months ago from the tariff. But some of that may also be because businesses are passing through the price increases slowly rather than in a single.
Absorbing the first part of it, yeah.
Exactly.
Fixed income strategy then at this time, given sort of where we are, what does that look like for you?
For us, when we look at the different sectors of the market and what screens is really attractive, I think from a perspective of a Canadian investor, we actually think that domestic fixed income looks really attractive right now, and more attractive than it has in several years. As the BOC has cut rates all the way from 5% to 2 3/4, we've actually seen rates further out the curve go up. So we've seen what we call a big steepening of the yield curve. So the premium that investors are getting to hold a basket of high-quality bonds, let's say with 5 or 6 years of interest rate risk, is relative to holding cash, has grown to close to 2 points now. So we think that in terms of fixed income strategy, investors should be thinking about a meaningful allocation to domestic bonds with a focus on high quality. So things like provincial bonds, investment-grade corporate bonds, bank bonds, those look great to us, both in relation to cash. And given that equities have staged such a powerful recovery, it might be a good time to rebalance.